MP Materials stock is the topic of today's presentation. And if you're an investor in MP stock or thinking about investing in MP Materials, then you want to watch this because it isn't your typical regurgitation of the bull thesis. We take a critical approach, a risk-averse approach to investing, if you will, across all the companies that we look at. Now, if you're not familiar with the bull thesis, start here. It's a presentation we did not too long ago titled Rare Earth Stocks. And like every exciting bull thesis, this is easy to understand and quite compelling. Rare earths are needed for many disruptive technologies, therefore demand and prices are quite high right now. China's the dominant provider, so the Western world wants to reduce their reliance, and only a few companies have the ability to do so, MP Materials being one of them. As I said, our goal is to identify risks and red flags, not to try and reinforce the bull thesis. That's a given. Now, I originally took the approach of wanting to use this firm as an example of how we use the 10K filing document. That's the annual report that every publicly traded company in the United States has to file with the SEC. We were going to show investors how we use that document to analyze any stock, but MP Materials is actually quite niche, so I'm going to use the 10K for this presentation, but we're going to do another video fairly soon that shows you how to walk through a 10K. Now, here's the first item in the 10K of interest. It's how the company describes itself, and this is pretty straightforward. They're the largest producer of rare earth materials in the Western Hemisphere. They operate the Mountain Pass Rare Earth Mine and Processing Facility, which is the only active rare earth mining and processing site of scale in North America. So that's notable. Again, going back to the point we made about very few companies being able to address this need. And this point here, the rare earth concentrate they produce is principally sold to a firm, and I'm probably butchering the pronunciation, but let's just call it Sheng. All right, and here's a picture of that open pit mine. And in the next paragraph, they talk about two stages that the company's at. So we're going to refer to these a fair amount throughout this presentation. So stage 2, this goes beyond just mining concentrate and sending it all over to China. That's what they're doing. So Sheng is a Chinese firm, and essentially what they've been doing is mining all this concentrate, sending it over to China. Okay, they want to reduce that dependence. Well, they'll need to start processing it themselves, and that's this stage 2 project they have where they produce and sell separated rare earth products. That's the processing activity that was taking place in China. They want it to take place here in the United States. All right, that's stage 2. Stage 3, they then want to take the output from stage 2 and then use that to construct metals, alloys, and magnets in a manufacturing facility they're building in Texas. Now, it looks like they want to become vertically integrated, but that's always easier said than done. Now, the first question that you might have is, what are the timelines for these two stages? Of course, stage 2 needs to happen first. Now, if we continue through the 10K, we can skip the rare earth overview because we already know about the opportunity. When we look at stage 2, they describe this as substantially complete and in commissioning, operational, in the first half of 2023. So we'll want to pay attention to revenues coming from that new component of their business. We'll talk more about that. Then there's stage 3. They say they completed the building shell in September of last year. But when will production start? That's what we need to know. Well, later on in the document, they refer to this gradual production ramp expected to begin in late this year, starting with alloys. So you want to pay attention to that. At most, though, hitting these targets demonstrates competency. It doesn't assure some great success story. And this is an important point here. We care about the value they're going to create through vertical integration, which isn't necessarily that obvious. It's really an unknown. So looking at some more business stuff here in that section of their 10K, they talk about this long-term supply agreement with General Motors from April of last year, where they're going to supply these alloys and finished magnets for electrical motors that they're going to produce in that Texas building, remember stage 3. The vertical integration into magnet production would establish them as the first and only supplier of rare earth magnets in the Western Hemisphere. That's great that they're an end-to-end Western supply chain solution, but what does that do for investors, right? So under the customers section, they talk about how they're selling the vast majority of their rare earth concentrate to Sheng, and that's something that we're going to want to talk a little bit more about, because this agreement expires in March of next year, and Sheng has the option to extend it. Now, you would guess that they would, given China's appetite for rare earths, but that's not necessarily a given, especially how MP Materials is now shaping their business away from a dependency on China. Now, when you get to the 10K part about risks relating to their business and industry, this is quite verbose, though it does contain some gems, such as the fact that China merged 3 state entities to establish this China Rare Earth Group that will account for more than half of China's heavy rare earth supplies. That's interesting. We didn't know that. And many statements in this section are CYA, it's cover your ass, or standard protocol. It's best to read the bolded statements and skim paragraphs, and if you have experience reading 10Ks, it'll help you navigate these sections quicker. But where you should go in the 10K for the real meat is the management discussion. This is where the analysis begins, okay? Check this table out on top. So this is the rare earth production and volume and sales, and we've highlighted sales, price, and cost because those are the relevant factors to track here. First thing to note, rare earth sales volume over time, look at that, not increasing very much, okay? What's increasing here? The variable to watch that's accounting for all their success right now is the price of rare earths, and that's actually quite volatile. You see their production cost is also increasing, but that relates to their stage 2 and stage 3 projects. Now we could do a math check here. Check this out. If you take 2022 sales volume, multiply that by realized price, you get almost exactly the product sales that you'll find later on in the 10K relating to the company's business. And then you have cost of sales, which doesn't actually reflect the production cost in the above table, but that simply means that there's some added components of cost of sales that aren't reflected. But what it boils down to in 2022 was a gross margin of 82%. And the success they had, as you can see here, is predominantly tied to the increase in the price of rare earths, which isn't a given that it continues increasing, sustains, it could even decrease. Here's a table in the 10K that's very useful that you could plot these variables over time. You have 12 data points, so quarterly information here for those key variables. And what you can do is take their past 10Ks and even plot this out with an additional 8 data points. And when you look at this, then you can start seeing some trends. So there's variance between production and sales. That's why they provide those two numbers. Price, that's quite a volatile variable here to pay attention to. And their production costs are steadily rising. Whilst that's attributed to the new stages, you want to be very careful about that. Now, I came across this statement that I quite liked. It says, profits are an opinion, cash is fact. That's why we look at something called net operating cash flows, and that's the cash that a business generates. If they're not generating cash, they're consuming cash, and that's when you calculate runway, right? But if they're generating positive cash flows, that means the business is generating cash they could use to survive, right? So in 2020, they had generated $3 million in cash, 2021, $102 million, and then 2022, $343 million. These newly found fortunes rely on the price of rare earths. That's very important to remember. We look at the balance sheet, we see $1.2 billion in cash equivalents, offset that with around $678 million in long-term debt. They're expecting to spend about $300 million in capital expenditures for their stages this year. So it seems like they're quite set in terms of cash, generating great cash flow as long as the price of rare earths stays up. And they have quite a bit of cash and a bit of debt. Even if you net that out, it's not so bad. Now, just some comments on the metrics here. The price of these commodities, it's volatile. It can't be controlled. So you need to pay attention to that. It's also not quoted. So one can imagine that it fluctuates quite a bit. Sales volume and price of production are two variables that investors should also pay attention to, of course. And the sales numbers ex Sheng. So when stage 2 is operational, that's going to represent concentrates that they're not sending over to China, right? They're processing this themselves and selling it to themselves. So we want to see those revenue segments separated out. Further down the line, we'll want to see sales for GM, right? That shows that stage 3 is complete. So going back to Sheng, the customer who's buying all their output right now, what if they stop buying? So what if this contract comes up for renewal next year? Now, it doesn't seem likely that when it comes up for renewal, they'll stop buying, but don't expect the PRC to act rationally when threatened. So that will be interesting to see what happens there. Now, assuming their production is capped, and we can assume that based on just looking at how their production isn't increasing much over time, that means Sheng is going to receive less over time as domestic or global sales ex-China gain momentum. Question we have here is, what value does that vertical integration bring? And once that starts happening and they start selling from stage 2 and stage 3, then that cost to produce is going to have other variables that need to be reflected, right? It's not just the cost of pulling the materials out of the ground, it's the cost of processing, it's the cost of turning it into magnets. So your cost of goods sold starts to change, and they're going to need to reflect that. Now, when you look at the company's last earnings deck, quite simple, clean. I actually liked it. Here you can see some variables. So we have that sales volume, right, multiplied by realized price to get their revenues. On the right, though, see that production cost? What they've done here is they've plugged in stage 2 related. That's great. So we expect to see this slide then start to show some gray on sales volumes related to stage 2. Then we expect that to be broken out, right? Sales going over to China versus sales from stage 2 versus sales from stage 3. Now, right now, this has a simple valuation ratio of 11 compared to the other tech stocks in our catalog that have an average of 6.5. And this is a different animal. It's a mining firm, so it's really not a fair comparison, but it's still a point of reference. This is the first time that we've even checked this stock. So we did all that analysis, and then we decided to go look at the ticker, and what we realized is this actually was a SPAC. It was a blank check company that went public in just about 3 years ago, and you can see the price chart there. So all SPACs debuted at $10 a share, so it's up several 100% there. When you look at their SPAC deck, obviously revenue forecasts aren't really going to make sense because they're dependent on a commodity that you can't predict the price of. But they were expecting stage 2 separated REOs, that's stage 2, to be operational last year. So that didn't happen. So they're behind schedule there. But welcome to SPACs, right? That's what happens. But we have a bad taste in our mouth from SPACs across the board. But of course, this company, like all others, needs to be evaluated based on its own merit. So the rise in fortune for MP Materials right now, all that strong revenue growth and all that great gross profit they're getting, that's related to the price of rare earths, which are going up. These will fluctuate based on supply, demand, and substitutes. For example, Tesla's moving away from using rare earths, right? How long will it be before other companies decide to do that because it's just too expensive? MP Materials is looking to vertically integrate. That sounds great on paper, but guess what? Soon they're going to be competing with other manufacturers of magnets and alloys. Are they going to be able to do that competently? We just don't know. Now, here's a question that came up while doing this research. Would accomplishing stage 2 have been sufficient? In other words, just remove that processing dependency that you had on China and then sell the output there. Why do you need to take it all the way down to the level of producing magnets and alloys? What extra value are you gaining from that to offset the risks that you're taking to get into that manufacturing business? So maybe that's a question that we'd ask people watching this video. In terms of this firm, we're going to check back in a year. It's more of a curiosity than anything. This is almost like an MBA case study. It's such an interesting story. It'll be fascinating to see how this all unfolds over time. But I'm going to put up that original video we did here on the rare earth thesis. But before you watch that video, please click the Nanalyze logo on the right, subscribe to our channel. Thanks so much for taking the time to watch this today.